All right, we should be live here. Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you all to this free webinar on how to use options as a hedging technique to protect your portfolio against downside risk. Couple quick housekeeping notes, and then I'll introduce our speakers and we'll jump right into things. First off, there's a live chat here. Feel free to make any comments you like in there. But let us know who you are and where you're watching from. It's always great for us to see, who the audience we're speaking to is. If you are not able to watch for the entire time, or you are watching this later on, don't worry if you can't watch the whole thing. This is being recorded, and as soon as we're done, instantly YouTube should post a replay video of this. So if you're taking notes, like I will be during this presentation, don't worry if you don't catch everything the first time around. You'll be able to watch the replay video to your heart's content and get all the information that you want to pull out of this. Just a reminder, one of the main reasons or main criteria that we have used at Wealthion in determining which financial advisors to endorse for our viewers, risk management has been a hugely important factor there. Because we have been so skeptical in the lead up to this year of all the inflated asset valuations of what's been called the everything bubble, that it was our strong sense that having the ability to mitigate risk of a downside correction would be very important. Of course, that's proven true in spades already here in 2022. One of the worst years on record for both stocks and bonds combined. Both of these asset classes went down. They're supposed to kind of counterbalance each other, but not this year. They both went down pretty dramatically. And so if you had good risk management practices, that protected you from a lot of that. Today's speakers who will be presenting on this topic are the partners from New Harbor Financial. You see them with me on this channel every week. They are extremely experienced in risk management, and they use options a lot to do that. We mentioned this a lot in the program. We haven't had a lot of time previous to this to really explain the craft of what they do. But because so many of you have asked, that's what we're doing now, is we're having a webinar where they're going to walk you through their whole process for how they use options like this to mitigate downside risk. I will introduce the guys in just a second, but real quick, what's going to happen here, the format is going to be, we're going to watch a presentation that the team put together. It's about 50 minutes or so in length. And then afterwards, we're going to have a live Q&A so that you'll be able to ask whatever questions you want to these guys. And we'll take as many questions as we can, and then we'll wrap things up. All right, so first let me bring the guys in just to introduce you to all of them if you don't know who they are already. These are the lead partners at New Harbor Financial. We have John Loder. Hey, John, how you doing?
Hello, Adam, and good evening, everybody. Great to be with everybody here. Hope you find this helpful and informative. Look forward to the Q&A part.
Yep, and John, I think we're going to be hearing your voice a lot on this presentation.
Unfortunately, I was anointed to be the voice of the video, but it was a team effort, and hope I don't put folks to sleep. Hopefully there's some good content in there for you.
No, you did a great job, and folks are going to see that firsthand in just a second. We also have co-lead partner Mike Preston. Hey, Mike, how you doing?
Hello, Adam. Thanks so much for putting this together. We appreciate it, and thanks everyone for tuning in and taking time out of your Monday night. It's late. Getting later for people on the East Coast, but hopefully it's worth it. And thanks for tuning in.
Great. And we'll jump into the presentation in just a second. But first, I've got to introduce Justin Griffin. If any of you have ever reached out to New Harbor, odds are pretty high that Justin was the person that you interacted with, at least first. Justin, thanks for joining us today.
Thanks for having us, Adam, and we're happy to get this off the ground. It's been a while in the making, but we're very excited to do it tonight. Thank you.
All right, so we're going to jump right in here, folks. Just a reminder, we will, after this presentation runs, we will then have live Q&A. So as you have questions, write them down and be sure to ask them when we come back on after this video ends. If you do have questions, comments, etc., post them in the live chat as the video is playing. I know the New Harbor guys here will do their best to try to chime into that live chat as best they can. But again, the main question and answer session will come after the video plays here. And without any further ado, let me see if I can get it to play here, guys.
Okay, welcome viewers to New Harbor's webinar on Introduction to Options and Options-Based Hedging Strategies. We're glad you're here with us today. The all-important disclosures come right at the front of this presentation because there are specific disclosures that are warranted by options. So please bear with us as we go through these. First of all, options are not suitable for all investors. There are special risks inherent to option strategies that can expose investors to rapid and potentially substantial losses. They do have unique and often significant risks that are different than other kinds of traded securities. We really invite any viewers to read this document called The Characteristics and Risks of Standardized Options. It's published by the Options Clearing Corporation, which is a clearing organization that oversees the trading of options. And any clients, for example, that work with our firm get this document sent to them in the course of their account opening procedures. Investors should consider contacting a tax advisor because there are specific tax rules that apply to options transactions. And of course, past performance of a security or strategy or index is no guarantee of future results or investment success. So I'd just like to cover the objectives of this presentation. Our goal is to introduce viewers to the basics of options and options terminology. For many, this is going to be new terminology if you're not familiar with options. And we're going to cover just a few of the option strategies that are commonly used as hedging and risk management tools, as opposed to speculation tools, which certainly there are plenty of those kinds of strategies that options can be used for. We're really focusing on simple strategies, just a few of them that we use and can be used for hedging and risk management objectives. And we're going to talk about some of the specific examples of the benefits of cost of using options. This is not intended to be an investment advice for any viewer. That can only be done with a direct relationship with a qualified financial advisor, or of course, if you're self-directed. This is not meant to be advice for any viewers. And it's certainly not intended to be an exhaustive education on options. There are many factors that we're not going to cover here, things like the impact of dividends on option pricing and dynamics, and the very many different ways options can be used for strategies that can accomplish a range of risk-reward scenarios. Again, we're only going to be focusing on just a few of the simple, more conservative hedging strategies in this presentation. So let's get into some options basics. So first of all, this hopefully is pretty elementary for you, viewers, but options are basically contracts between a buyer and seller that can be bought or sold. And options trade on exchanges, just like stocks and other traded securities. Many, but not all, stocks and exchange-traded funds, ETFs, have option contracts available on them. Importantly, each option contract relates to 100 shares of the underlying stock or ETF. So if you're going to do a hedging strategy pairing option strategies with a stock or an ETF, just understand that each contract relates to 100 shares of the underlying security. As I said, options can be bought and sold, and option buyers, otherwise known as owners, have rights but not obligations. They're conveyed rights that they can choose to exercise at their discretion, while option sellers have obligations to those buyers. So sellers do not have rights, they have obligations that must be met if buyers or owners exercise their rights. And again, because they trade on exchanges, options are quoted as prices on exchange. And those prices are quoted on a per share basis. So for example, if there's an option price quote of $5 per share, that equates to $500 per contract because again, each contract associates or covers 100 shares of the underlying securities. There are two basic option types, and these are known as a call option and a put option. These are the basic fundamental terms and contracts that option strategies employ. A call option gives the buyer, otherwise known as the owner, the right to purchase shares of the underlying security or stock at an agreed upon price. Likewise, a call option requires the seller, obligates the seller to sell shares of that security at that same agreed upon price if the buyer exercises their right. A put option, on the other hand, gives the buyer the right to sell shares of the underlying security at an agreed upon price. And likewise, a put option requires the seller to purchase the same shares of the underlying security at an agreed upon price. One thing you'll note here is that call options and put options are kind of like opposites of each other. One involves the purchase on the part of the buyer or owner, and that's the call option. The other is the put option, requires not the purchase or conveys not the right to purchase, but the right to sell shares. So puts and calls are kind of two opposite ends of the spectrum, if you will. And you'll see later on how that plays out in some simple strategies. And one might ask, what might motivate a particular buyer to purchase a call option versus a put option, and vice versa for a seller? Really, a call option buyer really wants or expects the price of the underlying stock to increase. So it's a bullish viewpoint on the part of the buyer, because essentially what that buyer is gaining is the ability to buy shares at an agreed upon price, and they want to buy those shares at that price if the market for those securities rises above that agreed upon price. Therefore, they're able to buy those shares at a lower price than market. And again, because the opposite side of the coin is a put option buyer really wants the price of the underlying security to decrease. This is a bearish strategy. They want to be able to sell shares of a certain security at a higher price than what they expect the market price to be in the future. And that'll come through again in some simple examples that we'll do in a few moments. Some key parameters to an option contract. First off, every option contract has what's called an expiration date. It's the date on which the owner or buyer's rights expire. They have the ability to exercise their rights to purchase or sell, as the case might be for a call or a put, the security shares, anytime from the date of the purchase of the option right up until the expiration date of that option. Once that expiration date arrives, and if they haven't or don't have good economic reason to exercise their right, that contract expires, and neither the buyer or seller ends up transacting under that option. There are typically many different expiration dates available for buyers and sellers to choose from when entering into an option contract. And this depends on the underlying security. The expiration dates can be as short as days from now into the future, or years. And again, it's going to be a function of the specific security. Some securities, very liquid stocks or ETF, for example, may have many alternative expiration dates in the future to choose from. One little nuance of the options market is that standard monthly options, those that are quoted month by month, and I'll give you an example of what we call an options chain or options quote screen. Standard monthly options expire on the third Friday of the given month. You might oftentimes hear things on financial media like option expiration date or quad witching. Quad witching is an industry term that relates to the expiration date, the third Friday of a month, where weekly, monthly, and index options, various different kinds of options all expire. And that only happens every so often. Continue on with some of the key parameters to an option contract. This is a really important one. We talked about earlier that option contracts convey a buyer the right to purchase or sell shares at an agreed upon price. That price is what's referred to as the strike price. Again, it's the price in dollars per share at which a call option buyer can purchase or a put option buyer can sell shares of the associated stock or underlying ETF. It's also, again, on the flip side, speaking of the obligations of the seller, it's also the price at which that call option seller must sell, or a put option seller must purchase the shares of the associated underlying stock or ETF. There are many different strike prices to choose from. Again, this is going to be a function of the particular underlying security. More liquid stocks or ETFs may have many different strike prices to choose from at various dates in the future. Less liquid securities might have fewer a shorter menu, if you will, of choices available to buyers and sellers of options. We can refer to these strike prices in relation to how they compare to the current underlying price of the security. So, for example, what we call in the money strike prices are those which are below, for call options, the current market price. So an in the money call option is a strike price of, say, 50 when the current market price is 60. It's below the current market price, the strike price. The opposite is the case for put options. In the money put options are where the strike price is above the current price of the security. So, for example, it might be a $60 strike price put option where the current price of that underlying security is $50. And again, the difference here is that, again, because call and put options are kind of different sides of a bearish or bullish strategy, the relation of in the money is going to be different for those. At the money strike prices are those which are essentially the same as the current strike price. So if the underlying stock or security is $60 a share, an at the money strike price would be $60 or roughly the same. Out of the money strike prices are those, it's kind of the opposite of in the money. For call option contracts, and out of the money strike price is where the strike price is above the current price of the security, and vice versa for put options. And out of the money put option is where the strike price is below the current price of the security. And I will say there's going to be a live Q&A at the end of this presentation on the Wealthion channel that we'll certainly be able to answer and dive into some more clarifying questions and answers on some of these concepts. Another key parameter to an option contract is the premium. This is the price that the option contract trades for on the exchanges. So this is the price in dollars per share that an option buyer must pay, and of course, that an option seller gets paid. The price of an option is essentially the value that buyers and sellers ascribe at the time of purchase or sale to their respective rights and obligations based on the probabilistic expectation of certain things. So first of all, it's a market expression of what the probability of an option contract ending up in the money on or before the option's expiration date. Because the bottom line is, whether you're talking about put options or call options, at expiration, the only value of an option is the degree to which it ends up in the money. If it ends up out of the money, it expires worthless to the buyer. They would never exercise their right because they can buy or sell in the open market at a more preferential price than they can under the option contract that they purchased. And in those scenarios, the seller gets to keep the premium that they pulled in at the time of the sale of the option. And as we touched upon before, option premiums are set by market consensus, again, based upon the views of the probabilistic value, and they're quoted on exchanges. So one might ask, what are the key variables that affect option pricing? Why, for example, would a buyer of a call option pay for the right to buy shares of a security, say at $60 per share in the future, if the current price of that security is $50? Why on earth would they pay that? The answer is there's some probability that on or before the expiration date, the price of that underlying security goes far in excess of $60. And that's why it has value based upon the probability of that occurring. So key variables that affect this is, first of all, time to expiration. By and large, or as a rule, the longer until expiration, the higher the option price or the premium will be. This is simply because with more time, the probability of an option ending up in the money and of being of value to the buyer is going to be greater than a shorter dated option. The implied volatility is a key variable. The higher the volatility of an underlying security, which is really the degree of variation, how widely or how variable and by how much the prices of the underlying security gyrate around some average or expected value. So the higher the volatility, the higher the option price will be. And again, this is simply because higher volatility means there's a greater probability that at some point in the future, before expiration, that the option will end up in the money for the buyer and therefore have value. And of course, they hope that that value is greater than the price they paid for that option. And conversely, the seller, of course, has a hope that the premium they take in is greater than the value that the buyer is conveyed by buying the option. The saying, there has to be two sides to a market. This is exactly a case in point here. The other key variable that affects option prices is the proximity of the strike price to the current price of the underlying security. We talked about in the money, at the money, and out of the money. Basically, the closer to the current price that an option strike price is, the higher the option premium will be. And in fact, the deeper in the money a strike price is relative to the current price of the underlying security, the more valuable the option will be, the more pricey it will be. And again, this is simply because close to the money or in the money options have a greater chance of ending up in the money than on or before expiration than do further out of the money options. There's two components of option value, and we're not going to dive too deeply in here, but we just wanted to kind of share some basic notions here. So there's what's called intrinsic value. First thing one needs to understand is that only in the money options will have intrinsic value because it's defined by the amount by which a call option strike price is lower than the current price, or in the case of a put option, the degree or the amount by which the strike price is higher than the current option current security price. So for example, a call option with a strike price of 50 that is associated with a security whose current price is 60 will have an intrinsic value of $10 per share. That's just simply the difference between 60 and 50, the amount by which the option is in the money. By definition, an option with a strike price that is out of the money will have zero intrinsic value because it's not in the money, as the definition makes it self-evident. The other component of option value is extrinsic value, meaning time value. And as I alluded to before, even an option that, say, for example, gives a buyer to buy shares of a security at $60 at some point in the future, even though the current price is 50, that will have value, even though it presently doesn't because the market price is lower than the strike price, but it has some probabilistic value because there is some probability that in the future, the price of that security goes above $60 and the buyer of that call option, for example, has the ability to purchase at 60, even if the market price rises to say $100 per share. By definition, the time value of an option goes to zero at time of expiration because at expiration, there is no future variability. We know with certainty how much, if at all, an option is going to end up in the money. Time value approaches zero also the further in or out of the money an option becomes. It's a bit beyond the scope of this presentation to explain that why, but it's a fundamental fact in the laws of options pricing. And time value is really greatest for options with at the money strike prices. Again, a little beyond the scope of this presentation to get into the math and the logic as to why that is, but it simply is. Here is our first chance to look at these concepts in real practice. This is an actual screenshot of an option chain for Apple stock. Many people are familiar with Apple stock because many people hold their devices in their hands or on their wrists. I should point out that while this was an actual screenshot, I don't even recall the time or date this was, and by extension, this is not a current snapshot, and it's not a recommendation or investment advice to purchase Apple shares or options. And also these prices that you see here and you'll see on the next page are not transactable because these are old stale prices that are not current. But what this shows is, and I'm going to use my cursor here to show, so we have Apple price here. At the time, the price of Apple was about 138 and change per share. And you'll see here a bunch of different months and days. So November 11, which happens to be the day that we are recording this video. So I do want to wish a a very happy Veterans Day, and much thanks to veterans who have served our country and may be tuning in here. You have November 18th, you've got November 25th, and you get the years here. These are 2002. And you can see for this particular stock, it is a very liquid stock. There are several expiration dates going all the way out to January of 2025. Okay. And in parentheses here are the number of days to expiration. So you can see you have quotes here at the time. This is sometime last week, I think, that I made the screenshot. You have options as short as 6 days into the future, all the way out to 804 days into the future until expiration. You'll also note that there are some lines here that are highlighted in red. Those are what are called weekly options. Okay. All the other ones, the ones in white, are standard monthly options, and therefore they expire on the third Friday of those given months. So for example, this line right here, the March 17, 23 option, these expire on the third Friday of March. Now, this doesn't show the actual option quotes. We'll get to that on the next page, where we expand out a couple of these specific monthly option expiration dates. So let's move to that next slide. Again, here's that same slide for Apple. Again, not transactable at these prices because these are stale and not current. But you can see I've expanded out the option chain for just some of the strike prices. You can see here I've selected to show 6 strike prices. In actuality, there are many, many more strike prices at any given month expiration that you can transact at than what I'm showing here. So I've decided to just, by way of comparison, expand out the December of 2022 option chain and the March of 2023 option change. So here you see that the strike prices, you have $125 strike price, $130, $135, $140, $145, $150. Right in the middle here is essentially where the current price is, $138. So you can see for the call options, I don't know if the contrast is enough in this video to show it, but the call option strike prices are on this is call option quotes on the left side. These are put option quotes on the right side. But you might see that the call option quotes are grayed out here. That's to show that those are in the money, meaning the strike prices are below the current market price of Apple. And likewise, the strike prices here, 140, 145, 150, are not grayed out. Those are because those are out of the money. And you'll notice that on the put side of the equation here, the opposite is true. Those higher strike prices are grayed out because they're in the money. And the lower strike prices are not grayed out because they're out of the money. So a couple of things I want to point out here. We talked about intrinsic value. You'll notice, for example, in the call options, intrinsic value is 0 for those strikes that are out of the money. And you can see that is non-zero or positive number for those strikes that are in the money, essentially below the current price of $138 per share. You'll also see that the strike prices, the intrinsic value increases the deeper in the money an option is. Let's look at the other component of option value, the extrinsic value. Okay, so you can see the extrinsic value is what, again, we call time value. You'll notice that it's lower the further out of the money you get. So this is an out of the money, the further into or out of the money you get. So this 283 is related to a fairly deep in the money call option. And this 241 is related to a fairly out of the money, very far out of the money option. And you can see the time value is the greatest right around at the money, okay? And basically the sum of the intrinsic plus the extrinsic is essentially the quote. These are the quotes, the bid-ask quotes for the option exchange. Now, like with any security, be it a stock or an option, when you buy a security, you're buying it at the ask or the offer price, and you're able to sell it at the bid or bid price. The spread there between the bid ask is essentially what the market makers get compensated for their role in facilitating orderly markets to buy and sell. So I want to compare the December option chain with the with the March of 2023 option chains. You'll notice for any given strike price, the options are more expensive, more pricey, and that's one of the key factors of option pricing we talked about. The longer into the future it's more expensive to buy an option and more lucrative to sell an option. But there's also the reason for that is there's a greater probability of those options ending up in the money. So for example, if we look at the 125 strike in December, you could purchase that for $16.80 a share. If you want to purchase that same right to buy Apple at 125 a share and have until March of 2023 to do so, it's going to be more expensive. It's going to be $22.30 a share. So again, and you'll notice if you study the comparable, if you look at the 150s, for example, the 150 strikes, to purchase a 150 strike call option in December, it's $2.50 a share, as you can see. And I'm sorry, the cursor keeps going away on me. $2.50 a share. And to go out to March, later expiration date, that same right will cost you $8.20 a share. And the same basic dynamic applies to the put option side of the equation too. It's just the different side of the coin. The put option gives the right to sell, not purchase. So it's it's basically flip side of a call option. So let's move on here. I want to get into some very simple examples of hedging strategy. Again, this is by no means exhaustive. It's just a couple of examples to see how these contracts can be used in combination with owning the underlying security. And so when you do these hedging, you don't want to look at the options and their results on a standalone basis because it gives only half the picture. So our clients, for example, that we do hedging for, it would be inappropriate to look at the options by themselves and the gain loss on the options without also looking at the gain loss on the underlying securities that these options are meant to hedge. It's the package deal, the package hedge that we're trying to accomplish a certain goal or outcome. So just to set the stage for these hypothetical examples, I've taken a screenshot in time of a particular ETF that tracks the S&P 500 index. ETF is short for exchange traded fund. And the ticker for that particular ETF is SPY. Again, I need to reiterate that this is not investment advice. It's not a recommendation or a suggestion for viewers to go out and purchase or sell this ETF. It's for illustrations only. And of course, ETFs involve their own risk, and folks should refer to the prospectus for any ETF, including this SPY ETF, before investing. So at this particular time, this is a screenshot for November 7th of 22, pre-market. Again, these are not transactable prices now, but this is what existed at that time. At that time, the price of the SPY ETF was $377 and about 6 cents per share. And at the same moment in time, these are the premiums that were being quoted for call and put options. So for the sake of illustration, I grabbed quotes for at the money strike price options, 5% out of the money, where the strike price is 5% out of the money compared to the current price, and then a 10% out of the money option. And you'll see I have a kind of a rather maybe standalone strike price here on the call option side at $409 strike price. You notice the premium there was $690. It's not by coincidence that I picked a strike that would create the same premium as this 10% out of the money put option was quoted at. And you'll see later when we talk about a caller example why I did that. But you can see a couple of things. We talked about the lower the strike price, the more expensive an option is going to be on the call side, and vice versa on the put side. The higher the strike price on the put side, the more expensive that option will be to buy. Again, it relates to the fact that call options give the buyers the right to purchase, and they want to purchase at a low price, and whereas put options give the buyer the right to sell, and they want to be able to sell at a high price relative to the market. So hopefully those concepts come through. So let's talk about the first strategy. It's referred to as a covered call strategy. And simply what this strategy involves is the simultaneous purchase of an underlying stock or security and selling call options against that same security. Okay. So in a moment, we'll look at an example of this using those SPY quotes that I just flashed on the prior slide. By selling the call option against that underlying security, SPY, in the example we'll cover, the seller is compensated in the amount of the option premium. associated with that call option. They get to keep that premium no matter what happens, no matter whether the buyer of that option exercises their right. This premium can be viewed by the seller as in many different ways, but a couple of ways you can view this is that the premium that you take in, that a seller takes in, is essentially some degree of a hedge against potential downside moves in the associated stock. But very importantly, that protection is limited to the amount of the premium collected. It's not an absolute hedge. You still have downside. It's just offset by the degree or the amount of the premium that you take in by selling the call option. It can also be viewed as a supplemental means of generating income against the stock that you own, essentially like a special dividend. And as we'll see in a moment, even a stock that goes nowhere in time from the time you sell a call option against it to expiration, that premium can essentially turn what otherwise would have been a 0% return over that period in the underlying stock to something better than 0% because the premium is able to be kept and pocketed by the seller, even though the option will end up out of the money or not exercisable by the buyer. Continuing the covered call strategy, just to talk about the underlying strategy thesis that might motivate this. It really can be best described as a moderately bullish strategy where the owner of the stock or underlying security has somewhat modest upside expectations for that security. Maybe they think we're in the late stages of a bull market or even a bubble, and they don't want to sell their security, but they want to provide some downside protection. This is what a covered call really is very well conceived to accomplish. So it's suitable in cases where one wants to reap potential upside in a stock or security, but importantly is also willing to forego upside beyond a certain level in order to get some degree of downside protection. Now, why is that? Again, if you sell a call option, you're agreeing to sell shares of the underlying security at the strike price, which would only be exercised by the buyer if the market price rises above the strike price. So in that situation, the seller of the call option is going to be required to either deliver shares at that lower than market price or deliver financial payments to the buyer of that option to compensate them for the value that associated with the fact that the price of the security has risen above the strike price. So it's as we'll talk about later, there is no free lunch to get this income, this partial downside protection. The covered call seller needs to be willing to give away upside beyond the strike price for that trade-off. So let's look at some graphical examples to illustrate what a covered call strategy might be able to do. And one thing I'd like to really point out is hedging strategies using options really are simply just a way to shift the risk-reward proposition of owning an underlying security to meet the owner of that security's objectives or viewpoints on the market, okay? So let's start first by looking at a graph, and I'll explain this graph, of simply buying an underlying security. Again, this is playing off the quotes from a few slides back for SPY, the ETF that tracks the S&P 500 index. So you can see the current price is this vertical line at $377 per share. And then on the horizontal axis, we have various prices that are possible in the future where prices increase from the current price or the price decreases from the current price. So you can see we have rising all the way up to 485 and beyond in the upside scenario, and dropping to 265 in a range of downside scenarios. And quite simply, if you purchase SPY at 377, this red line shows the return on the vertical axis that you would achieve if these prices along the x-axis were to be seen at some point in the future. So for example, you would see a 10% positive return if this price was achieved in the future from the date of purchase. And likewise, you would receive a negative 10% return if the price dropped to around here from the current price of 377. So you can see there's a 45-degree angle line here, which basically says you're going to get the same exact return here as what happens to the SPY ETF. Pretty logical and self-evident concept, I think. I should point out that these slides don't take into account fees or taxes or dividends. So they're very simplified, but just to make the point. So let's look on the next slide of what a covered call option strategy can do and does to the basic one-to-one up or downside scenario that just simply buying the stock by itself conveys. And here you see that same red line for the buy stock only return, but then you see a blue line that shows what if we sold an at-the-money call option. And again, those quotes are on the prior page. The premium one could take in for that is about 5%. So you see the distance between this red line and the blue line for prices at the current price and any drop below that is essentially the vertical distance is the amount of the premium that you get to take in. So you can see the loss in a downward scenario is muted or trimmed or reduced by the amount of the premium if you sell a covered call. Now, the trade-off for that is when you get to a price increase that starts to exceed the amount of premium you take in, you're leaving some money on the table. You're basically foregoing the gains in this triangle here in return for that downside protection. Now, if you had a wildly bullish viewpoint on this security or the market in general, that may not be a wise, I didn't mean to jump ahead. That may not be a wise wager. But if you are bearish or think that the upside is moderate, that may very well be a wise strategy because you get to take in this premium and not have the risk in your perception of giving away much in the way of upside. But let's look on the next slide of an example of what if you want to allow yourself some further upside than this at-the-money call option allows for. So the next slide shows that. You can see there's I believe to my colorblind eyes, there's a grayish colored line here. And you see you get more upside right here between this vertical distance between the blue and the gray line is the additional upside you get by selling a 10% out of the money call option instead of an at the money call option, but you get much less premium for doing so. And that's shown by this very much smaller distance between the red line and the gray line as compared to the red line and the blue line. Smaller premium means there's smaller offset of potential losses to the downside. So that's a very simple contrasting of the trade-offs between different strike prices and premium that you can consider in a covered call example. And again, there are many different strike prices that you can choose to balance that trade-off to what your particular assessment of the pros and cons are. Moving on to the next basic strategy, and this one involves put options, and this is what we refer to as a protective put strategy. This strategy involves the simultaneous purchase of an underlying stock or security, or perhaps it's one that you already own and maybe have owned for decades, and buying put options against that security. By buying the put option, the buyer of that put option is essentially securing absolute downside protection for price declines below the strike price. So whereas a call option, covered call, only provides some degree of downside protection, a put option provides absolute protection below the strike price. So it's very good for a bearish outlook. So this is very analogous to insurance that many viewers would be familiar with, either on their home or auto or health insurance. You're basically, when you buy a put option, a protective put strategy, you're trying to protect your investment from the proverbial house burning down. And like with any insurance, whether home, auto, or health, you have to pay an insurance premium. When you insure your home, there is a premium that you pay that basically says the insurance company will come to the rescue if your house burns down. And the amount of premium you pay is going to be a function of the amount of deductible that you, the homeowner, are willing to bear yourself. How much pain are you willing to bear yourself before the insurance company kicks in and makes you whole. And like with insurance, the same applies to put options. The more downside you're willing to bear, the higher the deductible you're willing to bear, the lower that insurance is going to cost, the lower that premium will cost, and vice versa. If you want a gold-plated insurance policy that absolves you from any risk or any downside, that's going to be much more expensive, and the same applies with put options. So the underlying strategy thesis for a protective put strategy can best be described. Well, this is a little bit semantics because it could also be viewed as bearish, but we've listed this as a bullish strategy. But it also is bearish in the sense that you think there's a decently high likelihood of price declines. Simply, a truly bearish strategy would have you selling the security outright rather than hedging it, because there is no free lunch. The cheapest form of insurance, as we'll talk about later, might simply just be to sell that security and go to something safe like cash or treasury bills. But again, in this case, we're categorizing it as a bullish strategy, but one where you unlike a covered call, you desire uncapped upside, but at the same time, you want disaster insurance against downside, and that you want that protection to be absolute below the strike price. So it's suitable in cases where you want to own the stock or security, but also want, again, absolute downside protection. One example, and there's many examples how this applies, but one example where this may make sense is for folks that have highly appreciated securities that have large capital gains, and there's a very decent chance that at the time of this recording anyways, after a multi-year bull market from the lows of 2009, you might have some securities that are highly appreciated. And you might be concerned or worried about the market or the gains in those stocks evaporating, but you don't want to incur the capital gains taxes, at least all in one bite, say in a given tax year. So you can buy protective puts to allow yourself to essentially kick the can on realizing those gains and the taxes associated with them, but at the same time protect those gains from evaporating due to a market decline. So here's a similar graph for that SPY ETF scenario. But in this case, so you have the red line, which shows the proposition if you just simply bought SPY and what the return on the vertical y-axis would be for various scenarios of price increases or decreases. You can see the put option is in the blue line. And what you see here is below, and this is for an at-the-money put option, you can see below any prices below the current price, because it's an at-the-money strike price, there will be no further losses. The reason why this blue line is below is negative is by the amount of premium that you have to outlay. In other words, the decline has to overcome the amount of premium you pay before the put option starts paying off. And the payoff of the put option in this case is basically this triangle here, the area of this triangle here. The more the price drops, the greater that option has value to you, because you get to essentially sell your shares for that agreed upon at the money price, which is $377 a share. So if, for example, the price drops to $275 down here, you still get to sell your shares to the seller of that put option at the strike price of $377. Now, again, this is a bullish strategy in that if the price increases even substantially, you're going to have uncapped upside. But again, the return is going to be offset or diminished by the amount of premium you had to pay for that put option. So that's why you see the blue line being somewhat less than the red line in these upward price scenarios, because that's the amount of premium you had to incur, and you don't get that back if the option doesn't get exercised. So here's another example of put option, but I've added a scenario where instead of buying an at-the-money put option and paying the relatively more pricey premium for that, you buy a out-of-the-money, in this case, a 10% out-of-the-money put option, and that's the yellow line. This is akin to saying, you know what, I want to get a disaster insurance insurance policy, but I'm willing to bear some deductible in order to make that insurance cheaper. So that's why you can see the yellow line, the protection is lower. You're guaranteed no more than about a 12% loss in that scenario versus no more than about a 5% loss in the at the money put option. But you can also see that the amount of gain that you have foregone by buying that out of money put option is less than if you did the at the money put option. It's simply the difference between the vertical difference between the yellow line and the red line and the blue line and the red line. You can see the difference with the yellow line and the red line is far less, simply because the premium for that out of the money put option was far cheaper, as we showed on several slides back where I showed you the quotes for SPY in that particular time and date. So let's tie these two strategies, the call and put strategy, together in what's called a caller strategy. And this is an example of what can be called a combination strategy. It involves the simultaneous purchase of put options. So you're paying premium by buying put options. Again, this assumes you own the underlying stock or security that you're looking to hedge. In this case, we're doing it for the SPY example. So it involves the simultaneous purchase of the put options. So you're paying for that insurance, and the sale of call options where you get paid. So you get premium inflow against that same underlying security. Now, you might recall on that slide, several slides back, where I showed the price quotes for the options and the underlying SPY ETF, there was a call option that I specifically chose so that the premium for that was the same as the premium that a 10% out of the money put option required. This is because we wanted to demonstrate a so-called costless caller, where you can essentially have the sale of call options fully and completely defray the cost that you would otherwise have to pay out of pocket for the put options. The strategy thesis here can be described as a hybrid strategy, where one is willing to cap the upside, but at the same time you want to protect the downside. Absolutely. Again, a covered call option, you cap the upside, but you're not protected beyond a certain level. It's only to the level of the premium. The caller strategy gives you that combination in return for foregoing upside beyond a certain point. You get absolute downside protection at the strike price of the put option. And like with the put only strategy, this can be a very effective strategy for protecting gains in highly appreciated securities, while being able to defer capital gains on those securities to enable a more thoughtful tax strategy on those capital gains. So this is what a graph of that strategy looks like. So you can see you're capping your upside at maybe 8 or 9%, something below 10%, in return for absolute downside protection beyond 10%. Now, the reason why one might be tempted to ask, why can't I, get a symmetric, cap the upside at 10% and limit the downside to no more than 10%? This really speaks to the market consensus that the probability of a downside move is somewhat greater. It refers to a concept called option skew or volatility smile. These are technical terms that are way beyond the scope of this presentation, but it shows a market bias that the downside is somewhat greater than the upside. It also is affected by dividends that are paid on the underlying security. And again, that's far beyond the scope of this presentation. So we hope those examples are helpful in illuminating some of the ways you can use options to hedge and fundamentally shift the risk-reward equation of owning securities, stock securities or other securities. So I want to just tie this up with a summary of some of the concepts before we go into a live Q&A in a few moments. So they can be used to accomplish a range of hedging goals with different trade-offs between upside and downside. Like with anything in life, there is no free lunch. The cost of using options, there is a cost to using options. So in the case of selling call options, the cost, so to speak, is the lost opportunity of capping upside. In the case of protected put option, the cost is literally the out-of-pocket cost of paying for that insurance, just like you have an out-of-pocket cost of paying for home insurance. And really, the cheapest form of hedging, if you're really worried about a stock or security going down, is to reduce one's exposure to that. You want to be mindful, of course, to tax implications, but there's no cheaper insurance than just getting out of it. And we like to use the analogy here in the Northeast where we are. In the winter, we can get some pretty nasty blizzards. And you may have a gold standard insurance policy on your automobile, but in those nor'easter snow blizzards, it simply sometimes just makes sense to keep the car in the garage and not drive, even if you have a great robust policy. That's akin to saying, you know what, let's park the car in the garage by selling some of that security, turning it into cash, and really just avoiding the risk altogether. Some pitfalls that we want to, for balanced reasons, to point out with hedging with options. You know, if you have a wrong assessment of the future and you sell call options too close to the money, that just means you have foregone more upside than you thought that then might have been desirable in hindsight. That is a cost, a lost opportunity of giving away too much upside. Likewise, you could buy put options that are too far out of the money, you know, essentially taking too much deductible on your own shoulders in pursuit of trying to limit your cost of insurance. That might have the unintended consequence of you know, bearing more risk than you really want to in hindsight, and before the protection kicks in. The other pitfall, and this is not exhaustive, we're just trying to point out some, is choosing expiration dates that are too short dated. You know, again, a buyer of an option, or even a buyer of an option wants time to work on their side. One of the tragedies of options is to have a right market call or right directional call in the market, but run out of time. You know, have the expiration date of the option arrive before your thesis has a chance to play out, and this could result in repeatedly burning time value if you want to keep doing that hedging program. So again, just to tie it all together with some benefits and risks of options before we get into a live Q&A. Potential benefits: you can literally define the maximum risk of loss over a certain time period. That's what, for example, protective puts allow you to do. You can say, no matter how bad things get, I know it won't get worse than X% additional downside. You can do that, and it will cost you some premium to guarantee that, but you can do that. With this, for example, you can sell covered calls. It's a benefit, and again, that can generate additional income and provide some degree of downside protection. And we talked about tax strategies, for example, on highly appreciated securities, using some of these hedging tools to preserve those gains and more thoughtfully incur the capital gains taxes over time. Some potential risks, again, some of this is for review, but we want to drive the point home. Capping potential upside in a very strong upward market in the case of selling calls. Spending too much premium on protected puts and never having that insurance kick in. You know, basically the pain and the downside never becomes large enough for those hedges to kick in. That can be a very frustrating thing for a protective put buyer. Options have a defined time to expiration, as we talked about, and you got to be right, not just on the directional view, but on the timing of that view, and very frustrating to run out of time and have a thesis be right, but just simply run out of time. Option pricing can move very, very quickly. And really, we can't underscore enough the importance of managing options positions actively and proactively during the time of their life before expiration. So with that, we hope that was a helpful, very high level introduction to options concepts and some of the hedging strategies. And now we'd like to conclude this part of the presentation and convert back over to a live Q&A. Thank you very much, and we look forward to answering your questions.
You're on mute, Adam.
Thanks. Good job, John. And I'll let everybody chime in the live Q&A, their feedback on the presentation, but at least the comments I've seen so far were that it was very helpful. And folks, again, if you enjoy, well, give us feedback on this webinar. You know, if you'd like to see us do a similar format on other topics. If so, you know, feel free to share whichever topics you'd like to perhaps see the next free webinar on. But if folks like this, we'll continue to try to do more of it. And now is the time, as John said, to take your live questions. So folks, start asking your questions in the live Q&A there. I'm going to do my best to pull them out. We might not be able to get to all of them, but folks, I will do my absolute level best. John, a couple of, or team, couple of questions here for you guys to chew on before I start pulling from the audience. Let's see here, no particular order. First off, John, you said that some of these options, can go out years, a year or more. But in most cases, if you are placing an options trade on, and then it comes up for expiration, let's say it's within a year, is that transaction going to be taxed as a short-term capital gain or loss?
Yeah, so the tax treatment of options, traded options like this, they're different if you were doing options on indices or futures. But for the examples like we talked about here, the tax treatment, and this is not a tax advice, I need to put that disclosure out. The tax treatment is more or less just like any other traded security. Holding period dictates whether it's short-term or long-term. And, basically we didn't really get into this in the video, but more often than not, an owner of an option or even a seller of an option is going to close out their position in the option prior to its exercise. So, for example, if you do a covered call strategy and we're right at expiration and the strike price of the call option is below the current market price, at expiration, that option will get exercised and you'll be forced to sell your shares to cover that call. The alternative, of course, is if you want to keep owning the shares, maybe because they're at a capital gain and you don't want to realize that gain, you can buy back those call options that you sold. Now, of course, you'll be buying them back at a higher price than you sold them for, and that will basically create a closing transaction. And the taxability of that will be based upon the difference between what you bought those back for versus what you sold them for. And it's a little bit tricky or non-intuitive for folks because the time sequence is backwards. Typically when you buy a stock, you're buying it and then selling it later. When you're using covered calls, you're essentially selling a call short, but it's covered by the shares of stock that you own. So it's a very conservative strategy. It's not risky. But you're buying it back to close that short position. So you're selling first and buying later. But when you close a transaction like that, quite simply, it's the difference between the purchase amount and the sales proceeds dictates whether you have a gain or loss, and whether it's a long or short term holding period, i.e. 1 year or less or 1 year or more, will dictate if it's longer or short term gains. There's a bunch of other nuances here about if an option is exercised, it basically just the basis basically in the security by the proceeds of the call option that you sold. But again, that's kind of a little bit more beyond the scope of the time we have here. I don't know if Mike or Justin have anything to add there.
Okay. All right. It doesn't seem like there'll be plenty of chance for you guys to chime in because I'm going to start just reading questions here, and I'm going to let whichever one of you feels motivated to chime in and answer it. Before I do that, I'm going to make a comment and I'll let you guys respond to it in any ways, which is, John, I think you did a really good job of distilling what can be a complex topic, down into understandable material for, a newbie here. And I think the 3 examples you walked through, you did a good job, both with the visuals and with your words, sort of making it generally understandable for folks. But this is the kind of thing, sort of like riding a bike, right? When you're riding the bike, initially you want to start on the tricycle, then you want the training wheels, but then you want somebody with you for a while until you've gotten the knack of riding the bike on your own without it falling off, without a hand on the back. Options, to me, feel somewhat analogous to that, where this is, for most people, it's probably not looking at the slides and saying, oh, great, I'm going to go and actually do this. Some can. But my strong encouragement would be to do it in partnership with somebody, I like to say a professional financial advisor, but somebody that really has experience doing this, because it takes a while before the math to become intuitive in your head about how these things play out. So to be able to come up with what you want to do, but then bounce it off somebody with experience, have them help you pick the right expiration date, the right structure for the trade you're trying to put on, and then to kind of help watch over your shoulder the first couple of times you do this to really make sure you're kind of getting it right and understanding it. That's sort of my strong advice to people. Do you guys have anything to add on to that?
I don't think so, Adam. Options can get very, very complicated, and most people shouldn't use advanced strategies, I think. I mean, even we, the so-called experts, stick mostly to the pretty simple strategies. Most of the time, we're doing covered calls or doing a strategy such as protective puts, or protective puts coupled with a short call, which is a collar, which simply puts a ceiling and a floor around a certain security. There's a lot of questions in the chat about IV, or implied volatility, and trading options into earnings, which we really don't even do. There's some questions about where you even find that kind of data. A product like ThinkPipe certainly has IV, but highly volatile stocks are usually volatile for a reason. If you're right about, for instance, a stock getting extended and it has high implied volatility, you can maybe profit by selling, for instance, call options against it. But we really don't hone in on the implied volatility. We're making more directional calls on sectors and on individual securities. So if you're bullish, covered call strategy works really well. If you've got a position that you want in your portfolio for a long time, maybe you're trying to reach long-term capital gains treatment, but you want to protect the downside, you can buy a put. If you don't want to pay a lot of money for that insurance over time, we'd suggest selling out of the money calls to help you pay for that insurance. I wouldn't make it much more complicated than that. I think his name is McMillan. I can't remember his first name, but he wrote a book on options. It's the Bible, and it's literally like 4 inches thick. And you could spend your whole life and career trading them, and they're really interesting, and you can do some really cool strategies. But I'd say keep it simple, particularly while you're learning.
Yeah, it's Larry McMillan, Mike, and Adam. If I could just flash the chart, because
hold on one second, because Justin's just holding up the book here. I want.
Oh, there it is. Yeah.
All right, John, you go now.
Yeah, I'd just like to key on something Mike just said. I think this is important. There's many ways to use options, and one of the ways we use them is to kind of exploit what we think are short-term, either overbought or oversold situations. So let me share a screen here. Bear with me, and I'm going to pull up my ThinkPipe screen. Let's see. Can you see this?
They can. Yep.
Okay. So this is and I just picked an arbitrary chart. This is a chart of a bullish dollar ETF. Okay. And, this has been a topic of discussion on Wealthion for quite a while, the strength of the US dollar. And, this is a chart. It's a daily chart. And you can see right here, each of these bars is a daily move in that ETF. And this red line is what's called an upper Bollinger Band. This fuchsia line is a lower Bollinger Band. Basically, 2 standard deviations around the moving average, which is this line. And you can see very rarely this particular investment would extend beyond 2 standard deviations to the upside. So quite simplistically, one might say, without looking at a whole bunch of other stuff, that perhaps the strength in the dollar got a little overextended, and that it was fairly likely there might be a pullback in the offing, even if the longer term trend might be higher. So that might be a scenario where selling some call options, if you own that investment, might make sense, because you might be saying that I'm assessing the probability of further near-term strength as being pretty minimal, and that maybe the near-term direction is downward, and I want to bring in some premium to offset that potential move. And I just want to make one other comment. When picking expiration dates, there was a question, does it make sense to pick, short-term dates or go out lengthy, a year or more? And it really comes down to, I think, the strategy and the thesis. We generally like to keep expiration dates pretty short, so maybe 3 months, 2-3 months, 1 month, depending on the trade, really because it preserves a lot of optionality in and of itself to reset those strike prices, to have a dynamic hedging strategy rather than getting buried or stuck in a longer term option and have the market move in a way that doesn't allow you the nimbleness to reset those options. So generally speaking, we try to keep things on the shorter end because we're tending to use them as shorter term directional hedges, if you will.
Right. And on that point, John, when the trade is going against the option strategy that you put in place, do you guys at New Harbor generally hold it to the end of the option's expiration and it just goes to zero, or do you hop out at some point?
It's circumstantial. We'll manage that trade in accordance with our discipline. Sometimes we'll take preemptive action to close out an option and maybe reset something at a different strike price. But it's difficult to say in a blanket statement. The bottom line is we manage the position in a dynamic way, and oftentimes do take action prior to expiration.
All right, and you're kind of reiterating the point I was making earlier here, which is just, the simple strategies you guys put in place are understandable, but there's still nuances around there, and having the benefit of somebody who's got a lot more experience than you as a newbie does, kind of giving you advice, and again, looking over your shoulder and maybe saying, hey, rather than ride this to zero because of these conditions, maybe you want to close it out and then start a new one a little bit, that type of stuff. It just can become really helpful here. Same way with bond math, right? Bond math isn't super duper hard if you're doing simple strategies, but it's just not something that most people are used to. It's a way they're not used to thinking. And so until it becomes intuitive to you, having, again, a guide really can be helpful in those first couple of weeks and months. All right, here is a question from B-Dub I want to put up here. When would a stop limit order be used versus a protected put? I think you said, Mike, protected puts are largely when you want to protect a position that you would prefer not to sell because you don't want to get the gains at this point in time. Is there another reason why you might prefer that over a stop limit order as well?
I would say that if you have a core position in your portfolio that you have a high degree of conviction in, for us, that would be something like the gold mining shares. We've owned gold miners for a while, and they've been disappointing from time to time. And they've been disappointing this year a little bit too. But for instance, back in the COVID time in 2020, GDX, which is an exchange traded fund that owns gold mining shares, went from something like 30 to 15. A lot of stocks did that, but gold miners went down really hard and fast. And at that time, we owned protected put options. I can't remember the exact strike, but I think it was something like 24. And so if we had a stop order in at 24, it would have executed at 24. And now maybe that would have been okay because the stock subsequently went lower. But we had the put option there, which essentially puts a floor in. The stock went down through 24, went to 20, went to 17, went all the way down to 16 or so. And we had the choice to do a number of different things. What we decided to do is to take some profits on that put. Now, you're never going to be exactly right on the timing, but in that example, what you can do is just leave it alone, and you have the choice of selling GDX in that case at let's say 24 at expiration, or you can adjust the put by selling it and taking the profit. You can even punch it down or lower the strike. You could sell the 24 put, take the profit, and then use some of that money to buy another put down at, let's say, 18. We call that punching down the strike. And I can't remember exactly the sequence of what we did. We might have even punched it down again, down to like 13 or 12. Every time we punch it down, we take a good percentage of the profit off the table, and we're committing some of the profit back to the new put, establishing a new floor at a lower price. The downside to that is if you're wrong on the timing, you're actually taking a perfect hedge, because essentially with GDX trading down at, let's say, 18 and a put option up at 24, you have no more risk. You don't really care if it goes to zero because you can sell it at 24. However, if you've got strong conviction that it's going to bounce, it's nice to be able to take some of that profit, which effectively lowers the entry price of the stock or increases income to the account, any which way you want to look at it, or it simply defrays some of that loss that happened, the unrealized loss. If you're wrong on that, you're gonna lose your protection. But we do often adjust puts when we see a rapid waterfall decline like that. And the same can be said of covered call strategies. If the stock goes up and through the strike price, we can adjust. We can roll up and out the option by buying the call that's in the money and then selling another one further out. so that we can kind of manage that trade, like John just said a minute ago. It gets kind of confusing, but you don't have to just sit and wait for expiration. You can do some things and take some action before that.
Okay, I've got a related question to that. It's not exactly what Nicole asks here, but it's related, which is the volatility of options. Granted, the volatility of any specific option depends upon the volatility of the underlying shares and what the markets are doing, et cetera. My point is over the time at which you are holding an option to potentially to expiration, it can move around a ton. It can be in the money, it can be out of the money. When you place an options trade, are you making a commitment that you got to watch this thing pretty closely?
Pretty much. You have to watch it. If it goes deep in the money, you don't really have to do anything. If it ends up in this example, if the stock is above the call strike price, it will automatically get assigned at expiration. Sometimes you'll see an early expiration. Normally that happens if there's an ex-dividend date. For instance, if you happen to own Exxon Mobil, the stock is at 113 or so. And if you were short a call, let's say an Exxon Mobil 100 strike call, well, that stock's $13 in the money. And I believe that ex-dividend date is either today or yesterday or tomorrow. You will get assigned. In other words, the person that owns the call you sold to them will exercise it the day before the ex-dividend date so that they own the stock before it goes ex-dividend because they want that dividend. So you got to worry about early assignments. There's no way that I know of to put in an algorithm or some kind of limit order that will automatically take you out of that trade with certain parameters. You really do have to monitor it, particularly during the week and maybe before the week that option expires.
Yeah, I'll just add option pricing gets progressively more sensitive the closer to expiration you get. So it's like Mike said, as you get closer to expiration, it's very important to monitor because a profitable position very quickly can turn into a non-profitable one close to expiration. Let's see, I had there was one other question that I saw that I wanted to quickly. Oh, someone asked about the definition of the Greeks. So you'll hear terminology like delta, theta, and whatnot. Anybody that took calculus and can recall differential equations where the different differential equations are rates of change of different underlying numbers. That's essentially what the Greeks are. So, for example, delta is the sensitivity of the price of an option for each price in the underlying, and then the next level of Greek there is theta, which is the sensitivity of the delta. They're basically just orders of differential equations on the underlying pricing dynamics of the option. Way too beyond the scope of this seminar tonight to get deep into those, but that's essentially what they are.
Okay. I kind of on a somewhat related note. Let's see. Tom here asks, are there educational websites where you can learn more about option strategies and more importantly, game out scenarios to model strategies more concretely with numbers? I don't know for certain about the latter part of the question, Tom, but I do know that there are good further explanatory videos on the more detailed and complex elements about options if you want to see them. There's a bunch on YouTube. Of course, you got to consider the source there. There's a service called Thinkorswim that I think is offered by TD Ameritrade. I am putting a link to it here in the live chat. I believe they've got pretty good content around options. And, again, for folks that want to dive more deeply, I think that's a pretty good resource. Guys, any others that you might recommend?
I was going to say Thinkorswim, Adam. That's what we use, ThinkPipes. It's great to model all kinds of things, max loss, max profit, which is really kind of important when you're entering an option strategy to understand what your maximum upside and downside is. As far as educational websites, I really can't think of any off the top of my head. Maybe John or Justin can, but I think Thinkorswim is one of the better ones.
All right, and there's a good comment here from Tom Hauberger saying that TradingView lets you trade against a fake slash paper account as well, meaning this is sort of a pretend or dummy account that you can play around with without, putting any of your real dollars at risk until you get the hang of things. There was a question. Sorry, back to your point earlier there. Gosh, I think it was you, John, or Mike's point is you guys were showing covered calls and protected puts. So, Mike, you were saying, hey, you got to be careful if you enter into these trades that the guy on the other end of the trade might decide to take action early, right? And you've got to be ready. So, in the case of a protected put, you've got to be willing to, give the guy his shares if he's exercising his call against you. I just want to note for folks too, we got some questions about naked calls and naked puts. Maybe we should talk about them for just a second. I think there's a reason you didn't put them in your presentation, John, which is that's not where you want to start because your risk on those can be extreme, right? That's where you can really get into trouble with options if you don't know what you're doing. But one thing you got to note if you're working with them is you have to have the either the funds or the shares on hand to be able to fulfill the contracted expiration if it indeed gets exercised, right? So I know a lot of people, they'll assume that the contract is going to expire worthless, but maybe it actually, ends up having a little bit of value by expiry, and then all of a sudden they realize that a whole chunk of money has been taken out of their account to fulfill the actual contract. I see you nodding, John.
Yeah. First of all, a naked call option, just to remind viewers what that is. It basically means you're selling a call option and you don't own the underlying shares. So it's totally different than the covered call example that we covered, because with the covered call, you have the shares, you own the shares that you can deliver. So let's say you have you sold the call option with a strike price of 50, and then some amazing news came out on whatever that security you sold the call option on, and the price jumps up to $200 a share. Suddenly, you are $150 a share underwater because the buyer of that option can say, you know what, the market's at 200, I want yours at 50. And unless you have those shares to deliver or create the gain to offset the loss you'd have on the option, you can have literally unlimited losses in selling naked calls. So anytime you hear the word naked in calls, just understand it's very, very risky. We absolutely don't do naked call selling. We don't even enable our client accounts to allow that. If we somehow accidentally wanted to try and enter one, they're just simply not approved to do that. So it's important to understand what that is.
All right, good caveat there. And John, do you guys ever see a time at New Harbor, not recommending for the average person here, but at New Harbor, where you may start employing more aggressive use of options, and maybe more to capture real upside? I mean, I know most of your work for the past bunch of years has been focusing on making sure that your clients don't lose a lot of money because you think the market's downside risk has been to the downside, more likely. But let's say we get the full bear market washout that we think we're due here, and you see better valuations coming along. Will you guys continue to limit the options in your portfolio to the strategies that you just mentioned, the callers, the protected puts and calls, or do you see actually potentially going out the risk curve at all once you feel that the market dynamic from a valuation standpoint is improved?
I'll give a first response to that. We're always going to be conservative in our use of options. That's the kind of clients we work with. Most of them want to protect their money. They don't want to speculate with it. But there are strategies beyond what we talked about today that we might pursue. So, for example, there might be times where we buy call options. Instead of selling call options, we go long call options. And that is financially equivalent to buying stock and buying put, the protective put example. But it allows you to do that with less capital and a little bit more leverage. And I'm not using leverage in a bad way here. It's a very defined way. But that's just one example of another strategy we might use if we want to get exposure with some downside protection. It's financially equivalent to buying a stock or a security and buying a put, the protective put, but you're using long calls to do that.
All right, great. Sorry, guys, I'm just trying to find this question here that I mentioned to you. Lots of appreciation here for the term naked when it comes to these things.
I'll just add one more thing while Adam's looking for,
Yep.
there are other strategies known as spread transactions where, for example, if you, buy a call option with a certain nearer to the money strike price, that's going to cost you a lot of money. If it's in a volatile security, you might buy that and then sell a higher strike price call option, which is essentially caps your upside. So it's like buying call option is equivalent to buying stock and buying put, and then buying an out, selling an out of the money call option. So it's kind of equivalent to a collar. There's a lot of different combinations that you can use that have a lot of equivalencies if you understand how they net out, and it might not appear that way on the surface to the casual options trader or the novice, but there's a lot of equivalencies that you can use to create certain objectives without putting a lot of capital at risk.
All right. Quick question here from Chris, and I want to get to another one that just came in. I'm not exactly sure what he's talking about here, but what about all the failure to deliver reports I see about individuals and firms? How is this legal? Maybe the question to come out of this is there any substantial counterparty risk here to these transactions? Or let's say the guy on the under end of your contract somehow isn't good for it. Will the exchange make you whole and then deal with the guy himself?
I'll take a quick try at that, and I'll keep it pretty brief because I'm not an expert on this question. But the OCC, or the Options Clearing Corporation, essentially creates a market in the options market. They create and destroy contracts as needed to meet the demand in the marketplace. So they stand ready to buy a call if you want to sell it short. And with all different types of trades and different sides, that's what they do. I'm not sure about the specifics if the OCC actually guarantees that market. I wouldn't be surprised if they do. But I'm not aware of any regular traded stock or ETF having a failure to deliver issue. And what we're talking about tonight is primarily publicly traded stocks and ETFs. We at New Harbor stay with the most highly liquid, high volume securities that have very tight spreads. That means you can buy or sell an option for sometimes as little as a couple cents difference. I'm not familiar with any failure to deliver issues there. I think maybe Chris is talking about in the futures market. In the futures market, there's a whole bunch of futures contracts on metals and grains and even stock indexes and interest rates. And he's probably talking about in the gold market, silver market. There's been some issues in the past with failure to deliver. It's really kind of outside the scope of what I think we can answer here. And in that case, it's really the Futures Trading Commissioner that would need to step in and enforce that. So I really can't comment any more specifically about that.
I'll just add one thing. Things like if you're going to sell naked call options, which again we don't recommend and we certainly don't do, that requires margins. So different brokerage firms require different margin postings to protect or provide a buffer against those things going bad, right? And we know there have been examples in financial history where brokerage firms failed to institute enough margin. Probably some of that going on with the FTX debacle, to point to a recent example. But the margin requirements in theory are there to maintain solvency if a trade goes badly against someone who's using it speculatively, which we don't do.
Okay, here's an interesting question that I'm not going to try to pronounce their name, but it's more sort of, can the tail wag the dog here? Can the volume of options traded, if heavy enough, can they push around the actual underlying value of the underlying stock?
Absolutely. Yes. I mean, the OCC, the market makers, need to hedge what they're doing. If I want to buy 10,000 calls on Apple, representing 1 million shares of stock, I just place a market order. That's which would be kind of a stupid thing to do, by the way, placing a market order. But if I place a huge order like that in the market, the Options Clearing Corporation needs to step in and make a market, which means they need to sell those calls to me. So they're going to be short those calls naked because they don't own the stock. That's a huge liability. So they're going to have to hedge that and defray that risk, which generally means going into the market and buying the shares. So yeah, you can definitely influence the market. In that case, the stock would almost immediately move up just based on that large call option buy.
Is this sort of what we saw with the meme stocks and Tesla, a year ago when there was just massive call buying in those companies?
Absolutely. I mean, ultimately, the security will revert to fair value in the long term, but in the short term, you can make or lose a ton of money, and people can be destroyed. There's firms that have been destroyed, doing this type of thing, and it happens all the time. I would stay far away from that and stay within your risk limits for sure.
Okay. Let's see here. I'll take maybe 2 or 3 more as we begin to sort of wrap stuff down here, because we've just passed the hour and a half limit here. I guess, well, okay, let me ask this one first. Folks have been asking about leaps, which I don't know if you identified them by name in your presentation, John, but a leap is it's an option that's out more than a year.
Yeah, it's basically, I think it's short for long term equity appreciation. I forget what the actual, but yeah, it's basically an option that goes out beyond a year.
Okay, and can you just talk about when you would buy a leap versus something a little bit more short dated, and how the leaps maybe react a little differently because they've got such a long duration?
Yeah. Well, it might, for example, be if you own a highly appreciated security and you don't want to sell it in one fell swoop, and you want to spread it out, say over 5 years, and spread the tax. You can buy a leap put option, for example, or maybe even a caller, selling a longer dated call option to offset the cost of the put. And by so doing, you can say, hey, I don't care what happens to the price of that stock 3 years from now, but I do care that it's never going to get any worse than X percent on the downside. If that's your objective, you might be looking at a leap, and you just basically, it's perfectly fine to basically just close your eyes and wait. It doesn't mean you can't optimize the trade by doing things along the way, but it's not a crime to enter that trade with the knowledge that you're okay so long as your objective is whatever the expiration date results were. But that's kind of an example. We prefer shorter term because it allows a more nimble resetting of hedge strikes in a dynamic market.
And one other example might be if you're trying for long-term capital gains treatment. That's another good reason.
Okay. Back to our Greek. Bob asks, when you hedge on a stock or ETF, do you have standard deltas you use for the collar entry, or is that fluid?
I would say it's fluid. The question says when we hedge a stock or ETF. So we really don't get into deltas or IV too much in making that decision. We're usually making that decision based on charts. So if a security has a chart pattern and it has resistance, let's say a $30 security has chart resistance at 35, we're probably going to sell a call option there, look at the premium that we get, see what kind of put we can buy for that premium, and then see if the chart makes sense. Like, for instance, is that a recent swing low? And so therefore we'll build a collar that way. And we might do it the other way, looking at a chart and saying what a key support zone is. We'll look to buy a put there and then see where we have to sell a call to pay for that put. And we'll just do it that way. We're really not making that decision based on deltas. Deltas are always going to be around 0.5 at the money, and they approach 1 as they're deep in the money, and they approach 0 as they're far out of the money. But we're making our decisions more on chart patterns.
Okay. Let's see here. So Reddy says, can we hedge with shorting stock instead? And yes, shorting stock is a way to hedge. It comes with its own risks. They're specifically saying, could we buy calls and short the stock instead? Any issues with this strategy?
That's certainly if you are objective is to profit on a decline in a stock, absolutely you can short a stock. You can't do that in an IRA. You need margin. And buying calls in conjunction with that is a very disciplined way to hedge a scenario where the stock, instead of dropping, goes higher and your short position would be largely underwater. So it's a way to hedge being short, basically by buying call options, because it basically creates a circuit breaker that if the stock shoots higher, your losses are capped because your long call option will start to be profitable as the short position gets worse and worse underwater.
My memory is a little rusty there, but I think that trade is the same as buying a put. Equivalent. It's basically the equivalent trade of buying a put, because if you short the stock, it has to fall by at least as much to put you in a little bit profitable to pay for what you paid for
your call.
Exactly, for the puts. So it's really the same thing. And then when you buy a put, your risk is limited to the premium paid. So it's mathematically the same trade.
Okay. So maybe a little simpler just to buy the put rather than having to manage two separate instruments. All right, guys. So as we begin to wrap up here, first, I want to remind people that this is something you guys have a lot of experience with. I'm going to put up a link here in just a moment so that if folks want to talk to you guys about getting help in implementing these strategies in their own portfolios, they can. But can you guys just sort of give a real world example of a recent moment where you have used any of these strategies to protect, and it's worked, protect downside in the New Harbor portfolio? I'm going to guess you're going to probably talk about what you guys have been doing with the precious metals mining shares, but really whatever example you think is most relevant from your recent activity.
Yes, we have used hedges pretty consistently with our precious metal mining shares, and got to tell you, it's been a bit of a mixed bag for us. We had some very good offsetting protection in the puts when precious metals really took it on the chin earlier this year, but the time experience over hedging a longer period of time certainly. In the presentation, we talked about one pitfall is choosing strike prices that are too far out of the money, and in effect, bearing too much deductible before the insurance kicks in. That's exactly what happened to us. If you zoom out over a longer period of time, the gold mining stocks have been on a pretty uninterrupted trend downward, with the exception of the last handful of days since about April. And frankly, in hindsight, we would have been better off basically having more robust, tighter put option strike prices and paying more for that insurance than having the larger deductibles and the lower cost of insurance that we chose. In hindsight, we would have been better off having tighter hedges. So nothing about this is guaranteed or easy. It's like with any trade, you need to go on with a thesis and a basis for what you think is a sound judgment. Doesn't mean it always works out perfectly. And that's a perfect example. Wow. One of the most recent put options we had paid off nicely when the metal shares kind of went down pretty quickly. There was plenty of premium that we burned along the way that would have been helpful not to have burned. Mike, I'm sure you can add some perspective to that.
Yeah, that's how options are going to work. That's how hedges are going to work. They're going to burn premium. If you're buying puts, for instance, just looking at straight up buying puts, you're going to lose over and over and over again, hopefully a small amount. And then if you do get a waterfall decline like you anticipate, then you're going to hopefully make all of that lost premium back at once plus a profit. So it's not a perfect thing. Normally, the best examples, or the most common examples of what we do, is buy a stock and sell a call, which is only a partial hedge. We took a stop in XLB, Basic Materials ETF, earlier this year that we owned, and I'm going from memory here, so don't hold me exactly to it, but we bought it around, I think, 90, and we sold a couple rounds of call premium against it. We brought in $5 plus or minus. So our cost basis was reduced to 85. Well, we had a hard stop on that stock at 78. We knew that if it went to 78, we were going to be out because it was a clear break of all previous levels. It was a clear break of support. In that example, we took a loss on the stock, but it was a $7 loss, $85 minus 78, $7 instead of 90 minus 78, 12. So we reduced our loss from 12 to 7. And so you do that over and over again. Some of your trades will be profitable, some of them won't be. If you're reducing your loss on the ones that aren't, it's a good thing. Now, of course, there's the flip side to that. You might limit your gain on something that goes straight up. So everything's a trade-off, but we do trades like that over and over again, and we find that overall it helps.
Yeah, and as we've talked about many times in the program, while it's easy to get caught up in FOMO, the research is very clear, as is just people's lived experience. We feel the pain of a loss about 2 times as much as we feel the joy of a gain, right? So the pain of giving up some gains to have good insurance means you're doing well. You're still getting gains, right? You're on your way to hitting your life goals. Where if you don't employ this insurance and then things go against you, not only do you feel the pain of those losses more, but you actually are behind in your life goals, right? So to your guys' point, the whole value of hedging is to make sure that you are losing less over time and getting more and more probability of actually being able to fully fund your life's goals. All right, with that, folks, we're going to bring this to a close. Just a reminder, if you do want to have a discussion with the folks at New Harbor about this, just go to the wealthion.com link you see there on this bottom of the screen there. Fill out the short form. It only takes you a couple of seconds, and we'll get you connected with one of those free conversations with them. I've seen some of the existing New Harbor folks chiming in the comment section here, guys. I will say it's very nice to see the general level of satisfaction and respect that they have for you guys. It validates, not that I need it, but that you guys are indeed a great partner. Folks, again, if you've enjoyed this, would like to see us do more of these, please let us know in the live chat here, your feedback. And again, if there are any topics that you'd like to hear us address in the future in a format like this, either let us know in this live chat, in the comments below this video if you're watching the replay, or you can just email us directly at info@wealthion.com. New Harbor guys, I'll let you guys have the last word here before we wrap things up.
Let me just say one thing and give a shout out to Justin here. Anyone that reaches out to us through that wealthion.com page that you just mentioned, Adam, almost certainly will get a call first from Justin. And Justin, maybe you could just say quickly what that experience is like and what they could expect.
Well, great. Yeah, I didn't chime in much here in terms of participating in the options strategies. I know Mike and John did most of that trading at the office. But yeah, as it relates to chatting about portfolios, thoughts and ideas about your current circumstances, we'd be happy to share our insight on it. And please reach out. But it's typically a conversation for us to each to understand each other and see if we're fit for what someone's looking for.
Great. John, I know you did a lot of talking in the presentation, but anything you want to say to folks as we part here?
No, just thank you. Thank you for the great questions. Thank you for the patience. It can get dry at points here talking about some of this stuff, but it's really important to know the details. This is not something to kind of go in half-witted on. It's important to understand these tools.
All right. And if you're watching this live, tune in tomorrow to the Wealthion channel. I've got a really fascinating interview with Jim Bianco, all about the unfolding implosion that's going on with FTX, the second biggest crypto exchange in the world. Super fascinating topic. In fact, it's just a crazy topic when you see, some of the latest developments going on there. But I just want to highlight it here because it really does emphasize why risk management is important. A lot of people with heavy exposure to that token and a lot of the companies that FTX was invested in, who literally, woke up, went to bed one evening, everything was totally fine, woke up the next morning, their investment was valued at zero or close to it. So this is, just one of the, signs from the universe that investing a little bit of risk management can go an awfully long way in uncertain markets like we find ourselves in right now. All right, with that, New Harbor guys, I want to thank you so much for putting together such a great presentation, such a useful presentation, and for making yourself so available to handle folks' live Q&A here. Everybody else, I want to thank you for joining us later in the evening on a Monday here, and really appreciate you watching, and look forward to seeing you guys again on the channel soon.
Thank you, everyone. Thanks for your endurance and staying with us tonight. See you soon.
Have a good night, everybody.